Hey everyone. Lately, the Federal Reserve has been telling us they're going to hold rates higher for longer. What does that mean for real estate? What does that mean for how real estate looks in the Las Vegas Valley? Well, this is the November real estate market update for resale single family homes here in the Las Vegas Valley. And we're going to look at exactly that question. How do things look? How have we been impacted by these interest rates and the other trends that may exist within the economy here locally? I am Justin Miller, co-founder and principal with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. So let's go ahead and dive right into the numbers. So the data for this video were pulled on November 7th from the multiple listing service, as well as the other sources from which I acquired data for these videos. The numbers, because they are recorded into the data set, reflect what took place during the month of October of 2023 and give us insight about what happened in that month, trends over the past month and past year, as well as some forward-looking information that tells us something about how the market's evolving within the next 1 to 2 months. Okay, so the first piece of information that I always look at is pricing. Pricing is interesting because it tells us something about where buyers and sellers are willing to meet in the marketplace, that we've got agreement between buyers and sellers as to the value of property. So pricing, median sale price for single-family resale residential in the Las Vegas Valley in October of 2023, $442,000. Now that is up. It's up $2,000 or 0.5% from where we were in September of 2023. More interestingly, in some manner, we're actually up year over year. And this is the first month that we've seen this all year long. We are up from $434,500 at the end of October of 2022. We are up 1.7%. So earlier this year, we had been down every single month from where we had been on the corresponding month a year ago. You'll remember I've mentioned multiple times over the course of this series that year-over-year comparisons remove seasonality, which is good. It gives us some better knowledge about how trends may be evolving, so we don't get stuck in thinking springs are just always amazing. Springs are amazing relative to the winter, but they may not be amazing year on year. In other words, spring may be great relative to the prior month, but they may be down from the year ago, which means that the trend is not nearly as good as one would think, or it could be better. Well, last year in 2022, we had peaked on pricing at the end of May at $480,000. And we started coming down from that point. In fact, we fell all the way to $415,000 at the end of November of last year. And we bounced up a little in December, came back down in January of 2023. And we've been below where we were on the year ago pricing all year long until now, the end of October of 2023. We're up by 1.7% from where we were 1 year ago. Okay, so that's really good news. Now, let me look at pricing in one other manner, as you know that I do occasionally, in fact, most of the time, for single family housing, and that is price per foot. And I look at price per foot not because it's as a standalone data point particularly interesting. It's not necessarily descriptive of very much, but in comparison to median sale price, it gives us a lot of insight as to the internal dynamics of the market and how the different strata of the market are behaving relative to each other. So if price per foot is up a lot, we know that the top of the market is performing better than the bottom of the market. Similarly, if the price per foot is increasing or at a lower rate or decreasing at a faster rate than the median sale price price, then we know that the top of the market is suffering relative to the bottom of the market. And we can see other internal market dynamics taking place here as well. Price per foot for October of 2023, $247 per foot. If it was $247,000, that would be amazing. And problematic, but $247 per foot. That is up $2 from $245 per foot in September of 2023. That is up 0.8%. We are up $4 per foot from $243 at the end of October of 2022. So we're up 1.6%. That's very much in line with what we're seeing on the median, where the median we were up 0.5% month over month, price per foot 0.6%, and at the median 1.7% higher year over year, price per foot 1.8% higher year over year. Those numbers are sufficiently close to each other. They're not statistically meaningfully different. And so we can say actually in the month of October, the market across all the strata were performing approximately equally to each other. So earlier this year, we had been seeing the top of the market, the top quartile, if you will, was growing at a rate less than we were seeing with the lower 75% of the market. In October, we saw that trend go away. And so we saw that prices at that top quartile were going up very much in line with what they were doing across the rest of the market. And so that's actually really good news. That's very healthy internal market dynamics. Now, that's pricing. And of course, pricing, important, tells us that buyers and sellers are agreeing at a price on the transactions that they're involved in. However, we need to know how many transactions there were. In fact, we need to know about supply and we need to know about demand. Well, supply is easy to see in the marketplace because that's the number of listings that exist. And so we'll look at that in a minute, but we also want to look at demand and how demand is actually existing within the market. And so the way we look at demand is we look at closed sales and we look at pending sales. And we know that that shows demand because there's no house that sells if it doesn't have a buyer. So buyer materializes, wants a house, negotiates for a house, gets into contract on a house, and closes on a house. That's demand. Now, is it supply as well? Yes, but there are better measures of supply because there are houses that are supplied that have not sold. So the only ones that sell have a buyer. So buyers' demand is told to us through closed sales and pending sales. So what do closed sales look like for the month of October of 2022? 1,533. Now this number is down. It's down 5.7% from the 1,625 that closed in September of 2022. Now this indicates maybe the demand came down, at least at the prices that we're seeing in the market. Okay, important to note that, but I want to think through that a little bit more clearly in just a second. I do want to give you that annual number as well. Last year, October of 2022, we had 1,582 houses close. So that means we're down 3.1% from where we were last year at this time of year in terms of demand being displayed in the marketplace through closed sales. So what's this telling us about demand? Well, let's look at this in a different way. We could say on the one hand, we're down 3.1% year over year. We could actually say we're down 39% from May of 2022, which was the peak last year. That's a very substantial drop off in closed sales. But we can look at this slightly differently. We can look over a longer time horizon. There have only been 4 months where closed sales of single family resale homes in the Las Vegas metropolitan statistical area were lower than the 1,533 that we saw closed last month in October of 2023. And 3 of those were November and December of 2022 and January of 2023. So we're looking at really low transaction volume. And that's important to think about. It's important to think about for a variety of reasons. One, it suggests demand has maybe been pulled out of the market. Now, we talked last month, demand may be existing and latent because the price to carry a home has become so expensive. And so I'll talk about that in a couple minutes, but it could be maybe buyers are just simply fleeing from the market for whatever those particular reasons happen to be. There's another thing to think about here that I want you to keep in mind as you're thinking about real estate generally, of maybe buying or maybe selling. If there's only 1,533 transactions that took place in the month of October of 2023, that means that there were approximately 3,066 agents who were involved in the particular transaction. Okay, so that's interesting. Why is it double the number of agents? Because each sale has a buy side and a sell side. And usually the buyer's represented by one agent and the seller's represented by one agent. It's possible that there's a dual representation, that a buyer and seller are both represented by the same person. It happens sometimes. It does not happen very frequently. But let's just say it did not happen in the month of October. That means 3,066 agents were involved in a transaction last month. Well, in Nevada, there's in the Las Vegas area, there's approximately 20,000 licensed agents. That means the average agent in Las Vegas is doing something approximately 6 transactions during the course of time right now. Now, that's a low number, and I want you to think about that in terms of when you're hiring a buyer side agent or a sell side, listing side agent, are the people you are hiring actually experiencing the activity in this market, or are they just out there occasionally? Now, obviously, some agents do a lot more than the average. We do substantially more than the average. There are some agents who do substantially less. There are agents out there, even here in November of 2023, that have not yet done a transaction this year. And you have to, A, feel bad for them, but B, you have to also think, as related to your own transaction, is that somebody who is going to be able to best represent you, because they may not have really inherent knowledge about what's going on in the market at any particular time. So think about that. The number of transactions has become so low. And this is something that last year I used to make presentations on statistics every month to Keller Williams, because they'd asked me to do that. This year I've declined the ability to make those presentations because they take a long time to create, and I haven't had the time because I've been too busy with transactions to be able to take the time to make those presentations. But there are a lot of agents out there who are actually not doing enough business, and they're having to take second jobs and other such things. So something to think about. All right. Now, that's a number of sold. Now, of course, there are also contracts that go into existence, that come into existence, which are pending. They've not yet closed. That number also represents demand because, again, that's the writing of a contract. So for October of 2023, 1,534, actually one more than had closed. Of course, pending contracts are likely to close the following month. So these are contracts that are teed up to close in November, which in and of itself actually suggests that November might be completely flat with how we saw things in October. Now, the 1,534, this is up 0.6% from the 1,525. It's up by 9 houses from what we had seen in September of 2023. is being pending. It is up 11.8% from the 1,372 that we saw as pending in the month of October of 2022. Now, I will comment, this number is also low. This is the lowest number of pendings that we've seen since January 2008, with the exception of October, November, and December of last year. Remember, December is our cyclically always the lowest month of every year. So we always expect Decembers to be really low for pendings. Well, we can look at all the prior Decembers all the way back to January 2008. We've only seen one December that was lower than this number on pending, and that was last year. And October and November also last year, lower than this number. This is a really low number for pending home sales. This is something to keep an eye on here. Now, why do I think that we're seeing such a drop-off in written contracts, either closed or still pending? I don't think it's necessarily the demand is fleeing the market, although I'm starting to get a little bit concerned about certain market segments. Rather, I think this has to do almost entirely with the interest rate environment. So I've talked about this issue actually a lot over the past year and a half, 2 years, as affordability. Last month, I looked at the exact same information a little bit differently, and I want to highlight it here the same way again this month in this video. So if we look back to the prior cycle's high, that was in the 2006 timeframe, going up to the start of the Great Financial Crisis. June of 2006, we saw the median sale price at an inflation-adjusted $448,800. So very slightly higher than what we've got right now, actually. But if we take that number and we impose on it a 90% loan-to-value 30-year fixed-rate mortgage, now loan-to-value means that you're putting the other party in cash. So that means a 10% down purchase with 90% being funded by the bank. And we apply the average interest rate that existed at that time onto the median purchase price, 90% of the median purchase price. We get a number, the number of dollars per month that mortgage is going to cost for principal and interest. Does not take into account taxes, does not take into account insurance, does not take into account utilities, does not take into account homeowners association dues, just principal and interest. And that number came out to, on an inflation adjusted basis, so current year dollars, $2,595 per month. If we look at this last cycle's peak, that occurred in May of 2022 at $480,000. If we took that May median home, $480,000, and applied the exact same terms, 90% loan to value, 30-year fixed rate loan at the average interest rate, which was at that time 5.33%, that gave us a monthly payment of $2,391. So even though the cycle high price was an extra $35,200 higher in May of 2022, the carry cost, the monthly cost of carry on that loan, was actually $204 less per month. So kind of interesting. So affordability actually had increased. Well, interest rates have been going up since May of 2022. They started going up actually in the beginning of 2022 and gone up very steeply. But by November of last year, well, by October actually of 2022, we'd seen interest rates peaking at about 7.39%. And then they started coming down again. And now we've seen interest rates go back up again higher. So where are we now? Well, in October of this year, we know we were at 442,000 median sale price. And the average interest rate at the end of October of 2023 was 7.90%, according to the Mortgage Bankers Association. So if we apply a 90% loan to value on that mortgage for the median sale priced home on a 30-year fixed rate loan, that gave us a monthly cost of carry for principal and interest only, $2,856. Now, this is really interesting because what that means is even though prices were down from the 480 down to 442, come down $38,000, the price to carry that home had actually gone up really substantially. So we are now sitting $261 more per month than we were in June of 2006. We are sitting at $465 more per month for the same home, right? Basically the median home, $465 more per month than we were in May of 2022. Now that's a really big shock. In fact, $465, that's almost 20% higher than what we were looking at in May of last year. So really substantial increase in the cost of carry. That has meant that a lot of buyers have been priced out of the market, not because the sale price is so high, but because the interest rate has gone up so substantially. Well, I suspect there's a lot of buyers who are latently in the market, a lot of demand sitting there that's hidden right now because people have pulled back, either cannot afford or they need to readjust their ideas as to what they can actually buy in this market. So we had seen last year that as interest rates were going up, prices were coming down, but they were only coming down to the extent that people could actually pay a level amount across time when taking out a mortgage. This year in 2023, rates have continued to go up. They've continued to go up so much. At the same time, pricing has been recovering and recovered approximately half of the downtrend from the top to the nadir at the beginning of this year. That the cost of carry is up really substantially. And so I think that it's simply that we're seeing the, if you will, the shadow of that high interest rate environment. And that makes it look like demand is disappearing. Now, it's possible demand is actually disappearing. I think that's not the case. I think it's literally, this is being driven by interest rates. And as we see interest rates come down, we're going to see pending contracts and closed contracts increase substantially. So we'll see how that looks over the course of time. The problem is the Federal Reserve has declared they're going to keep rates high, maybe go slightly higher, and they're going to keep them high for a long period of time. So this could have a dislocating impact in the market for a while. All right, so what about, well, let me point out one other item here real quickly because it's kind of interesting. A lot of people have been talking about how these high interest rates are going to lead to lots of foreclosures and you'll be able to get into the market getting a great deal on a foreclosure. In September, there were 13 foreclosures. What about October? His interest rates went even higher. And these interest rates, right, sitting at 7.9%, this is a legitimately high interest rate. Once we got over about 7.4%, interest rates went above the longer term historical average. So, you know, when we were sitting at 3% interest rates 2 years ago, that was a really low interest rate. There's no two ways to talk about it. 7%, sort of the average over a long period of time. So now we're not sitting at 7%, we're sitting at 7.9%. That's a legitimately high interest rate. So in the high interest rate environment that we have now, have foreclosures started to really go up. 13 in September. Checking my number here. 9 in October. We're not going to see lots of foreclosures. You're not going to be able to get into the market with an amazing deal on a foreclosure. If that's what you're hoping for, keep hoping. And, it's a terrible thing to hope for that other people will be foreclosed upon so you can benefit from it. But if that's your strategy, you're going to be holding out for a really long time, because we're just not seeing foreclosures coming into this marketplace. We're not seeing delinquencies coming to this marketplace. If you want to get a good deal on a repossessed car loans are actually having trouble, and car loans are being closed on, and cars are being repossessed. So maybe you can get a good deal on a used car, but not in the real estate market. It's just not happening. That's not going to happen. Okay, so that's demand. Demand is being beaten up by high interest rates. So what about supply? Well, supply is also harmed by the high interest rates. As a seller thinks, if I sell my home, on which I have a 3% mortgage, I'm going to have to replace it with some other place to live, and I'm going to have to pay a higher interest rate on that replacement property. So we've actually seen significant deterioration in inventory, or homes for sale, the supply of housing in this market over the past year, actually. So what do we look like for October of 2023? 400, that would be really bad. 4,131 houses for sale in the Las Vegas metropolitan statistical area. That's down 4.3% from the 4,318 houses that were for sale at the end of September of 2023. This has been literally a full year, 12 months of dropping inventory levels in this market. First, very, very fast dropping of inventory levels. The pace is moderating. We're only down 4.3% from the last month. But to give you an idea of how globally impactful this has been, we are down 57.6% from 9,747 houses that were for sale at the end of October of 2022. We've gone through almost 2/3 of the inventory of available housing in this marketplace no longer exists. And by the way, when we had peaked in September of 2022, the highest level of inventory, we were just below the average level of inventory that we've seen in this market over a couple of decades. So really, really, really low levels of inventory here. Don't let anyone tell you otherwise. And these low levels of inventory are impactful on pricing, because there's much less for buyers to look at when they're actually looking. Of course, that means there's less for them to offer on, less for them to contract on, which is also causing numbers of transactions to be low, because buyers may not be able to find what they want within the supply. So down 57.6% from the supply that we had a year ago, and down 4.3% from the supply that we had at the end of September. Now, of course, supply is renewed through new listings, newly listed resale units that some seller decides they want to sell their unit, and it gets listed into the market. That number for October of 2023, 2,232. That's down. It's down 3.5% from the 2,314 that we saw at the end of September of 2023. That is the lowest non-December number, except for November of 2022, that we've seen going all the way back to March of 2008. So this is a really low number of newly listed resale units coming into the market, greeting an already very depleted level of inventory. We are down 21.4% on newly listed from October of 2022, when we had 2,842 coming in. And by the way, this number, you'll remember, of course, in 2020, we had a pandemic that shut down the economy. This number, 2,232, it's actually 9% below the lowest number of newly listed resale homes in the Valley during the pandemic shutdown. That's how low these numbers are. They're really importantly problematic. So something to keep in mind. All right, one other piece of information I want to give you, and that is back on market. Back on market are pending contracts that have failed for some particular reason, and that product came back into the market. That number, 653 for October of 2022, that is 29.9% of contracts that were written failed. They fell out. If you're thinking about listing your home or you're thinking about buying a home, make sure when you're talking to a real estate agent that you're asking them about back on market. Ask them what's causing it. Ask them what they're doing to try to prevent that from occurring on the properties that they're representing or to the buyers that they're representing, because you need to protect yourself from this back on market phenomenon. These numbers are very elevated. They've been very elevated since just before the pandemic closure. They're running twice what they should be. And it's a phenomenon that exists within this market. Pay attention to it. Okay, I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell houses. We help people build wealth through real estate. Please, again, smash the like button, hit the notification bell, subscribe if you've not already. Please share these videos with your friends, your colleagues, your neighbors, your family members, anyone who you think might benefit from the insights within these videos, as well as our ability to help with real estate transactions. I look forward to seeing you in the next video. Thank you.